The box, the bag, and the wrapper analogy, mutual fund investing. This is Ken Boyd with the Accounting Accidentally Substack page. You need to open a retirement account so you can take the deduction on your tax return. Do you have a 1099 DIV for dividends you were paid on that IBM stock? Did you hear these sort of questions during tax season? Completing your tax return is tough enough, and then tax preparers and investment advisors throw in these other questions at the same time. We hear them a lot, and mutual funds in particular can be really confusing. For example, what investments are in my mutual fund? Do I pay taxes every year? If I sell my fund, what's the tax impact? So to clear up these issues, I'll use the box, the bag, and the wrapper analogy. Amazon shipments. So let's assume that you get a box from Amazon, and inside the box are 10 bags, and each bag has individually wrapped pieces of candy. Got it? So what's the box? The box is the type of investment account. The box is the type of brokerage account you use to purchase your mutual fund. So generally speaking, there's two types. Taxable account, interest on bonds, dividends on stock, capital gains or losses are reported on your tax return in a taxable account. On the other hand, if it's a retirement account, the most common retirement account is a 401k account you may have through work. You can set up all other types of retirement accounts if you're self-employed. The tax impact of interest, dividends, and capital gains and losses are deferred. There's no tax until you withdraw the funds at retirement. Another point, 401k retirement accounts include contributions from your employer that are not taxed until retirement. Other retirement plans tax the contributions before they go in. But once they're in the box, in the retirement plan box, there's no tax impact till you take funds out. So what's the bag? The bag is the mutual fund itself. Inside the box, the account, there may be one or more mutual fund investments. For example, Washington Mutual is a fund that invests in U.S. equities or common stock. To diversify your investment risk, your account may invest in different types of mutual funds. You may have stock funds, bond funds, a balanced fund, which is both. You may have a large stock fund, small stock fund, highly rated bonds, lower rated bonds. You can get a variety of mutual funds. So what's the wrapper? Well, the wrappers within the bag, the candy wrappers, that's your fund investments. A bag or mutual fund may own dozens or hundreds of individual stocks and bonds, and those are the candy wrappers inside the bag. Washington Mutual, for example, owns dozens of stocks in a variety of industries, and as of this writing, if you look at the prospectus, the fund owns 188 different stocks. So, clearing up tax confusion. If your box is a taxable account, you're going to receive tax documents that report interest income, dividend income, possibly capital gains and losses each year. If your box is a retirement account, there's no tax impact until you sell the investments. Now, if your mutual fund buys and sells stocks and bonds within a taxable account, there's a tax impact. Stock and bond sales within your mutual fund in a retirement plan, there is no tax impact until you withdraw funds at the end. So the box is the account, the bag is the mutual fund, the wrappers are the individual stocks and bonds inside the mutual fund. So I hope that helps. That's as far as we'll get right now. And to get more writing on accounting and finance, you can go to accountingaccidentally at substack.com. Thanks.